This is Retirement Lifestyle Show. I'm your co-host, Adrian Nicholson, and I'm happy to be back. Lately, I've been getting a lot of questions like, will the market go up and down on the short term in the second half of the year? Is the economy still strong or headed into a recession? What are the major risks out there that I should be watching or monitoring? To help clear up these answers, this episode is all about important market alerts. So, what are market alerts? Market alerts are notifications that highlight major movements or key events in the market. They help investors and people stay informed, act quickly, and make smart decisions without having to track every single headline that gets thrown your way. So I think this topic is very crucial and very important because today we are in a digital world. There's information everywhere. We're always receiving constant notification, headlines, news updates, just a plethora of information that we have to deal with, make sense of, and sometimes even make a decision on. And sometimes not all of it applies to your personal finances, your situation, your retirement, investment, or even your lifestyle goals. So knowing which alerts to pay attention to can help you be a more sharper decision maker. So we can start off with a crucial one. This is earnings. So we are just getting past earnings season, and most of the S&P 500 companies beat expectations, which is great. We got strong reports from the Magnificent Seven, which always helps the market. These are Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, Tesla. And a lot of their focus has been around artificial intelligence. Is that still making a lot of money for these companies? Are other companies out there still spending a lot in this space? Is this continuing to help companies and businesses grow, become more efficient? So we are starting to see some positive headlines and positive news around that space, which is very bullish and positive for the market in the second half of the year. So monitoring those alerts from these companies and these earnings is a good starting point to focus on these headlines. Next are consumer brand companies. Some common ones that you listeners or viewers might know of is Nike, McDonald's, Visa, Starbucks. They also had some solid earnings, and they're showing that the consumer, for the most part, is still strong, and there is strong demand out there. I think it's also important that these companies can also show you where the consumer are spending money. And I think this is a good starting point for you to always stay on top of these companies when they come out with earnings, when you get those news or those alert notifications, to look into and see what they're talking about and what the consumers are doing, where companies are spending money, and where are some of these technologies headed and which direction they're going into. So overall, earnings reflect the health of corporate America and the confidence in the economy. They often drive markets, whether it's up or down. So ultimately, what you need to do is look beyond the headlines. If you own, let's just say, a broad index fund, or you own investments in a specific sector like technology, consumer discretionary, we have energy, healthcare, review how they performed or what they're talking about during earnings. Focus on those notifications, those alerts that you're getting from these companies, because if you do invest in these companies, you need to be aware of what's going on, what they're talking about, if they're showing any signs of weakness, or ultimately what their outlook is, because their outlook sometimes is just as important whether they beat on revenues or earnings. So the last thing I want to add in this section is this may be a good time to update your bullpen or your bear den. So what this is a bullpen could be stocks that you're very interested in that you don't own, that you may want to own in the future. You're just maybe trying to find the right time, or maybe see how they're doing on their earnings before you ultimately make that decision to buy them. So having a list of stocks on standby to act on once earnings season comes or once you get some more information could be very helpful when things are calm, so to speak, in the market. And then the other one, the bear den, like I mentioned, these could be stocks that you own right now, but are underperforming or are not doing well, and you may sell in the future, where you're one bad earnings call away or one management decision away from saying, all right, everything's kind of stable, calm in the market right now. Maybe this may be a good time to unwind a position that's been underperforming in my portfolio. So I'm going to move us on to the next market alert. And this is a big one, and one that a lot of investors follow, is the Federal Reserve. So we know in July, the Fed kept interest rates unchanged. Their tone still remains cautious due to inflation and tariff-related uncertainty. So why this matters is the Fed's decisions impact a number of things that impact consumers, investors, and individuals. A common one that people focus on and look at a lot are 15 to 30-year fixed rate mortgages. What the Federal Reserve does with interest rates has a very big impact on what type of rate you'll get on a mortgage. Something else this also impacts are yields, whether it's a CD at your local bank that you want to invest in, whether it's a treasury bond, short or long, or it's a money market savings account. The interest that you get on that, or the money you ultimately make on this investment, is influenced by what the Federal Reserve does with the interest rates. Currently, right now, these fixed incomes, like I mentioned, CDs, bonds, money markets, you can get around 3 to 4%, which is a decent rate. If you turn back the clock, let's just say 5 years ago or 7 years ago, you will only get more like 2 to 3%, sometimes even 1%. So you're still getting paid. But again, what the Federal Reserve does and what their outlook is and their tonality determines what will happen to these rates on these investments in the future. So that's why monitoring what the Federal Reserve does, following those notifications, you get those alerts that they make on certain stances or certain data that they're reading, can help you make a better decision or see where it might be going. So definitely stay on top of Fed announcements, especially if you're looking at, long-term loans or you're building a fixed income investment. It's crucial that you stay aware of what's going on here. So I'm going to take us to the next thing that kind of correlates with what we just talked about on the Federal Reserve's decision, and this is the labor market. So we got even more data last week, and again, we're getting a lot of economic data, earnings. So this is a big time where people are getting a lot of notifications, alerts, and it can be a lot. But again, ultimately, what I want you to get from this podcast is staying on top of some of the things that really matter when it comes to the markets, the economy, and your situation at the end of the day. So what the labor market showed is that July non-farm payrolls rose about 73,000, which was below expectations. So this showed that there is a weakness in the labor market. And you may ask, why is labor market important? Why do I need to monitor that notification if I come across it on my phone? Well, a weakening job market may signal a slowing economic growth, which could influence the Fed's rate cuts. It also creates uncertainty, which we know investors do not like uncertainty, which sometimes leads to market volatility, big swings up and down in the market. So if you're concentrated in a certain sector, stay alert to a change in consumer confidence. A soft labor market could impact companies' earnings and investor sentiment. An important trend to follow as well, which is very new today, that I think you listeners and viewers should follow to see if this is going to continue or not continue, is that companies are growing out there, but their workforce is shrinking. And this is something too where we need to see, is this going to be a trend or not? And the reason why I say that is because that's crucial when the Fed determines what are we going to do with interest rates. We have to look at price stability, which I'll talk about later, and the labor market. Well, if workforces are shrinking, you could see bad labor data come out, and that too can cause the Fed to hold rates or increase rates. So that's something too that we need to, follow and be aware of. If companies begin to continue to grow, but their workforce is shrinking, because if the workforce is shrinking, that can impact consumer spending, consumer confidence, all the things that are really the bedrock of the United States economy. So this is something too that investors need to be aware of and stay on top of as new news and economic data comes out in the future. So let me touch on price then, since I just mentioned that. I think that's also important to follow. One of the big headlines, one of the big alerts that people sometimes focus, I think, too much on sometimes is inflation and prices. which, I get that's a very big part of people's financial plan. Are their expenses increasing? How is inflation impacting my long-term longevity when it comes to my assets? I definitely understand why it's an important thing. So that's why it made it on my list. So, headline inflation still remains high. And we know that the Federal Reserve's target is that 2% target. They want to get inflation around that 2%, and then they may feel comfortable about easing policy. So there are still sticky areas of inflation, which means it's staying elevated and we're having a hard time just really driving certain prices down. So as we know, high inflation, it can erode investment returns. It can reduce purchasing power. And this can be especially important if you're a retiree living off a fixed income. Interest rates staying higher for longer is something that you will need to address at some point or another. Whether inflation's here one day and gone the next day, it's something that you really need to focus on and look into. The reason why I mention that is because ultimately inflation, like I said, can erode your investment returns. Let's just say inflation picks up again, it's around 3 to 4%, and your investments are returning 6 to 7%. Well, once you factor in those numbers, your investment return is more like a 2 to 3% if you factor in inflation. Going back to purchasing power, your fixed income is a fixed amount, so it stays the same. Well, inflation increases and prices continue to increase, then that fixed income has less purchasing power. You're going to purchase less goods, less services, which can really impact somebody's retirement. So, what are some ways to, beat inflation, combat inflation? Adrian, you're telling me that I need to stay on top of where prices go, what is going on with inflation. Well, how can I combat this? So, the three things that you can look at, and again, these are not investment recommendations. Consult an advisor, have a conversation, do your research. But three ways you can keep pace with and beat inflation is number one of the most common things are equities, stocks. Depending on what your risk tolerance is, you might want to have an allocation towards equities that you're comfortable with, that your plan supports, that's in line with your risk tolerance, that can help your assets grow and your money grow in equities and individual stocks. That can help outpace and beat inflation. Another common one, which was big in 2022 when inflation was picking up, are Treasury inflation protected securities. These are just bonds that can appreciate, or let's just say follow along with what inflation's doing and also pay you interest. And then the next thing is maybe you, going back to equities, maybe you look at some dividend growing companies that can appreciate as far as their stock price, but also pay you an income to help you increase that purchasing power while also keeping up with inflation. So the last point I want to make on this is always check your assumptions. If you're big into financial planning out your retirement, you have some assumptions baked in there. And two big assumptions are inflation and investment return. So if you want to see how long your assets last, how long your money will last in retirement or out in the future, and you're making projections, what you use for inflation and your investment returns can distort the data. What I mean by you might have a really good scenario if you use higher returns and lower inflation. Vice versa, if you use higher inflation and lower returns, you might see a negative outcome. And that's where I am a big advocate for saying, run both scenarios. See what the best case scenario is if inflation is down and your investment returns are good, and see what the worst case scenario is if inflation rages and you have poor performance for a couple of years or something like that. Run both scenarios to help you make and be a better decision maker is what I'm getting at here. And that's why, again, going back, it's crucial for you to understand and see what's going on with prices, what's going on with inflation, what's the data, what are the economic experts saying out there when it comes to it, because that can really impact not only you financially, but also your spending in retirement, which is a big part of your lifestyle and what you want to do in retirement and how you want to enjoy it. So I'm going to move on to a next thing that you need to stay on top of. And this market alert is a big one this year, which is tariffs. And one of the big ones that we are continuing monitoring that we're not getting a lot of clarity on is what's going on with US and China as far as their trade deal. Specifically when it comes to technology, because that's going to be a big one that are driving both markets. Are there going to be deals made? Are we going to find any middle ground? That's something too that investors are really need more clarity on, because that's going to have a significant impact on markets. And if trade tensions increase, we know that can disrupt supply chains. And if supply chains are disrupted, that goes back to inflation could pick up. Prices could go up in your grocery stores, your local main street areas, whatever it is, you can see an increase in prices. Higher tariffs is something that we need to stay on top of and be vigilant of and see how that can impact us. Because if all else that doesn't go our way, or does go our way, it could boost market confidence. So staying on top of tariffs and what happens in that regard is crucial here. Stay up to date on tariff talks, see what those alerts and what those news informations are giving us to help us be more informed decision makers. And two, when it comes to tariffs, let's just say your portfolio is invested in global companies or is supply chain sensitive as far as a sector that you're in. This matters a lot to you. So this can have a significant impact on certain parts of your portfolio. That's why you need to be aware of these alerts as they come your way. Lastly, the alert that I think we all need to focus on as well are geopolitical risk out there. Whether it's the potential peace deadline between Russia and Ukraine that's approaching, the ceasefire negotiations, which have stalled and tensions are rising with their hostage negotiations. All this stuff matters because it causes geopolitical instability, which can shake up global markets. This can cause energy prices to surge. This can cause defense stocks to fluctuate. Ultimately, this leads to investors' fear, which can trigger volatility. So review your international exposure. Make sure your portfolio is diversified across regions and sectors to absorb any potential shocks. So my closing thoughts are, these alerts aren't about predicting the markets. They're about helping you respond with clarity, not fear. Stay informed, stay diversified, stay long-term focused. Thanks for tuning in to Retirement Lifestyle Show. I'm Adrian Nicholson. See you next time. We're still going strong. Take control and achieve your goals. And I hope you have a great rest of your summer.
Schedule a conversation with Roshan, Adrian, or Eric today at retirementlifestyleshow.com. Roshan and Eric are certified financial planner practitioners. They, along with Adrian, are investment advisor representatives and serve clients across the U.S. with financial planning and investment advice through Arete Wealth. If you found this show helpful, gained knowledge, or enjoyed the time you spent with us, tell your friends and leave us a 5-star review. This will help others discover the show. To access our show notes, to download any of the tools mentioned in today's podcast, to ask us a question, or to schedule a conversation, go to retirementlifestyleshow.com. All opinions expressed by podcast hosts and guests are solely their own. While based on information they believe is reliable, neither Arete Wealth nor its affiliates warrants its completeness or accuracy, nor do their opinions reflect the opinion of Arete Wealth. This podcast is for general informational purposes only and should not be regarded as specific advice or recommendations for any individual. Before making any decisions, consult a professional. The show hosts offer investment advice through Arete Wealth Advisors, LLC, an SEC-registered investment advisor, and securities through Arete Wealth Management, LLC, member FINRA, SIPC, and NFA. Finally, our music is The Chance by Jason Shaw in Audionautics. It's part of the YouTube audio library, and it's licensed under a Creative Commons license. I am Ray Voices. Thank you for listening.